Hello, my name's Henry Eichler. I chose Ford Motor Company as my company of interest this year, and I'm very excited to be here today to talk to you about how I went about valuing the firm. So let's jump right into it. Here's a little roadmap, if you will, about what we'll be talking about today, and let's dive into it. First, we got to understand the industry a little bit. This industry, the car industry, car manufacturing industry, is highly cyclical, with much of its performance being tied to macroeconomic activity. Think things like large cap, US equities, interest rates, consumer expectations, things of that sort. Along with this, it's a highly capital intensive industry requiring large expenses on things like research and development and capital expenditures and various other fixed costs which require much scale to become profitable. Right now, the industry is going through a time of technological disruption as we, as a nation and the world more broadly, transitions from that legacy combustion engine, the gas guzzling car, to a greener future of electric vehicles. Ford has a unique place strategically in this mix. They've been going through a period of major investments to try to transition their platform into an electric vehicle operator. This involves aggressive capital expenditure spending, which has impacted their short-term cash flows and furthermore has increased the risk to the firm. Uh, the implications for this valuation shows that currently the market values various comps of Ford at a wide range of multiples, and we'll see how this has a dramatic effect on the different valuations that one can arrive at. So first, we'll talk a little bit about how we derived the WACC and the return on assets. I used a 4.42% risk-free rate. This was the January 2025 one-month U.S. Treasury bill, one of the safest, if not the safest, debt securities you can hold. Makes it a great proxy for the risk-free rate. I used a 20-year annual return average of the S&P index to arrive at a return around 10.34%. Along with this, we calculated an equity beta for Ford of 1.65. This was done by doing a regression analysis comparing monthly returns over the last 5 years of Ford compared to the S&P 500. This 1.65 figure means that we can expect the Ford return to be 1.65 times the magnitude of the market return. With this, we can then calculate a cost of equity using this equation here. Our expected or our equity risk premium calculated by that difference between the market return and risk-free rate is 5.92%. Then multiplying that figure by the beta and then adding back the risk-free rate, we arrive at a cost of equity for Ford of 14.2%. Next, we have the return on debt. Right now, Ford sits at a credit rating of around triple B minus. Along with this, through going through their 2024 10K filings and looking at all their debt instruments, they pay roughly around 7% for their debt. That's the coupon required for them to sell at par. So this gives us a pre-tax return on debt around 7%. Then when we take into account a fair tax rate of around 25%, we take 1 minus that tax rate and then multiply it by the pre-tax return on debt to arrive at a post-tax functional return on debt of 5.25%. With these values, and then with these values in mind, we then just need the weights for the capital structure of Ford. We see that they're a highly levered company with 75% of their enterprise value being in debt, with 25% in equity. With these two figures, we can then calculate both a return on assets and a WACC. For the return on assets, we arrive at 8.46%. This is using the pre-tax return on debt, and it slightly overstates the WACC because of its lack of consideration for the interest tax shield. Once the interest tax shield is taken into account and we use that functional 5.25%, we arrive at our WACC of around 7.5%. This is a pivotal number. This is what we will be using to discount our future firm cash flows. So now a little bit about our model assumptions. Ford's compound annual growth rate over the past 5 years has been around 3.5%. I opted to use that as their sales growth for the coming 2 years, with then stabilization coming and returning to around 2.5% in year five. Along with this, our gross profit margin has historically been pretty stable around this 18% figure, a very low gross profit margin. I expect some increase in this margin to around 19% in year five. This is a reflection of their operational efficiencies as they continue to learn more and create more in the electric vehicle space. Now, some of our working capital assumptions. We kept accounts receivable days were fairly stable with only a single outlier year in COVID of 2020, wherein people were reanalyzing their use for a car, and that number got expanded up to around 150. But taking a more stable approach over the past 4 years, and even looking back further than that, we forecasted a constant range of around 125 days. Account payable days were also fairly consistent. We held them constant at 55 days, which was in line with the historical average and precisely similar to the past year and quite similar to the year before that of just in around 52 to 57 or so. Finally, we have inventory days, which was remarkably consistent year to year, always within the range of 36 to 40 days. We took the simple average of the two and held constant at 38 days. Next, our final assumptions are for EBITDA and CapEx. We noted that the historical average for EBITDA for Ford has been around 10%, 10.5%, though they have more recently, they've been directionally positive and have reached a plateau in the past 2 years of around 12%, an improved rate. We forecast that 12% in year one and then continued growth to around 13.5% in year five. This is a reflection of electric vehicle scaling as well as reduction of overhead costs towards their legacy combustion engine as those models will be phased out in the coming years and less capital will be required for research on that segment of the company. Next, we have CapEx. I opted to use a depreciation multiplier to calculate CapEx, starting with 1.25 in year one and then falling to around 1.1 in year five. The fact that these numbers are all above one reflects the fact that Ford is investing beyond replacement level, showing that they're increasing their net PP&E balance as they continue to reorient the firm and produce in a space that they have not until very recently. Furthermore, this is also within their historical range of around 0.9 to 1.4. Moving on through these figures, we can then arrive at a terminal valuation using two separate approaches. First, we have the growing perpetuity approach. We took the year five. Well, first, let's talk about we have our WACC of 7.5% that we calculated. I opted to use a 2% growth rate. This growth rate is simply pegged with annual expected real GDP growth. As I see Ford, they've been around for over 100 years, and they've shown consistent growth around this like 2% rate over the long run. And I believe that that's the closest and most accurate figure moving forward. We then took our year five cash flow, multiplied it by 1 plus that growth rate to receive a forward cash flow in year six of 9.7 billion. This was then divided by the difference between the WACC and the growth rate to receive a year five terminal value, 177 billion, discounted back to today using that WACC compounded for 5 years to gain a present value of $124 billion. Next, we have the EBITDA multiple approach. Here we see Ford and many of their peers. These are all car companies or heavy machinery manufacturers, motorcycles, things of that nature, companies with similar capital structures, more or less. We see that Ford currently sits at a 14 multiple, but a median multiple is what we use to value the company of around 9.5x. Through this, we took our year five EBITDA of $29 billion and then multiplied it by that median multiple and to arrive at a year five terminal value of $276 billion. Once again, we discount to present day to a value of around $193 billion. a stark difference between the two. And this seriously underlines the importance of model assumptions, especially in regard to terminal values, as they are quite sensitive figures and can be greatly affected by what are ostensibly small changes. With these in mind, we can predict a cash flows for the company in the coming 5 years. Up top, we have our unlevered free cash flows with our two terminal values below. And then at the very bottom below the bar, we then discount all those cash flows to the present value. And then in the final cell on the bottom right, we will see our summed cash flows along with the terminal value, all expressed in present value figures. We see, again, this discrepancy of around $70 billion between the two methods. Now for some comparison between all of these figures. First thing to note is, again, we see that $70 billion difference based on the two multiples. As we go through, we see that that equity value is expressed around $114 billion for the EBITDA multiple, which works out to around $29 a share. This is as compared to both growing perpetuity and the prevailing market rate, which sit quite close to each other around this $40 billion mark, and then being around $10 or so per share. And then on the right side, you can then see the various capital structures with these valuations in mind, and how they sit differently than one another. Then we conducted some sensitivity analysis to come about to try to understand better what key drivers affect the firm. As you can quickly see, the two largest drivers are gross profit margin and especially EBITDA margin percentage. We see that with changes in that EBITDA margin percentage as we move up or down, uh, it dramatically affects the value of cash per share. All these figures are based on cash per share in 2029. Total cash and short-term equivalents divided by shares outstanding. So as we can see that if Ford is able to attain that high side of EBITDA margin, that they in fact actually can reach that evaluation of around $29 a share in the future. However, this is all contingent about increasing their margins, as will be Ford's biggest test going forward. Gross profit margin is same. It is high for similar reasons as EBITDA. And then we can note that our working capital requirements, such as AP days outstanding and AR days outstanding, have modest effects on evaluation with similar impact as CapEx. Interesting to note that most of CapEx's effects are on the downside. And then finally, interesting about this graph is the modest effect of sales growth and how that is not moving the needle much, especially relative to things like EBITDA. Finish off to go over the kind of key points that we've touched on. We see that this EBITDA multiple at $29, using the EBITDA multiple, we get that $29 share value. And this is a massive premium to the current share price of around $10.30. We note that the growing perpetuity reaches a much closer figure to the prevailing market rate. This does not necessarily mean that it's a better measure, but it does mean that the market is at least in a more agreement with this operation. Finally, we see EBITDA and gross profit as our key drivers of firm value, as was seen in the last graph. We also see how our assumptions in the terminal value will cause very large deviations and changes in the evaluation. We see that capital expenditure intensity and electric vehicle transitions are going to heavily impact our cash flows going forward. This is an important consideration as we think about our cash needs moving into the future. The market is likely pricing a lot of uncertainty into both Ford and its peer group. This is not surprising given that it is a bit of a novel industry and there's much market share to be clashed over, though these early movers like Ford, they have a high opportunity for success, though with runaway R&D and CapEx costs, they could also sink the ship pretty easily. Thank you so much for your time. See you soon.